And for turning out bright and early. This is, I think, perhaps the 8th Bay Area Economic Forecast event organized by the Bay Area Council Economic Institute. We're really pleased and honored and appreciative that the Federal Reserve Bank of San Francisco is hosting us for the second year. Can't think of much of a better venue for an economic forecast. We'll try not to be Delphic in our panel. Now, John Williams may choose to be Delphic, but hopefully we'll be able to shed a little bit of light and insight today on what's happening in the economy and what we think may happen in the economy in the year ahead. And want to thank our lead partner on this, our partner in crime, Accenture. This is the 4th year that Accenture has sponsored this event. In addition to enabling it to happen, they're terrific content partners. As you will see in the panel, we're going to have more toward the end of the program. So many, many thanks to Accenture for hosting us and being part of our program now for 4 years. It's hard to miss the fact, just working here every day, that we are in the middle of an extraordinary economy in the Bay Area and an extraordinary economic period. For those of us who were around during the Great Recession, 2008, 2009, and the aftermath of that, and those of us who were here in the region for the very, very fun dot-com boom and bust, it's no secret that this region is subject to an extraordinary level of volatility. We tend to go to peaks a lot faster and higher, and we've been known to fall a lot deeper and faster. And a lot of that is perhaps because we are an economy that's led very much by investment and venture investment and innovation in a broad range of industries and technologies that end up, at the end of the day, leading and changing the world. And there's great swings of enthusiasm, momentum, and then there's a fallout. And we've seen this happening now for, in a very dramatic way, over a good 15 years. Yet it feels very good, I think, for most of us that we are in an extraordinary period right now. If you look at the construction going on around us, the employment levels that we'll talk about later on, the fact that the world very much is flooding into the Bay Area right now. The tech corridor is not just Silicon Valley, it's between San Francisco and San Jose and throughout the region. And our partnerships with both large and small companies, entrepreneurs from virtually everywhere in the world are expanding literally as we speak. So I think this is a very interesting time for us to be gathering to talk about what's the basis for this, what's the fly in the ointment. There's always something to worry about in the economics world and where this may be heading in the next year. So as I said, we'll get on with the program. I first want to introduce Mary Hamilton. And Mary from Accenture, she is the lead for Northern California for Accenture Technology Labs. And she is also the managing director responsible for global digital experiences, which she must run the world because we are constantly in the midst of a global digital experience. So whatever's good and bad, we can ask Mary to explain that to us. But she works with clients around the world on this. The lab has been a touchstone for Accenture for more than 20 years, working with clients, looking at the changing ecosystem and the opportunities around technology and startups. It has a presence in France, a presence in Virginia, China, India, and right here in Silicon Valley. So very pleased to introduce Mary, and then Mary is going to introduce John Williams, the president of the San Francisco Fed. John will make some remarks. We're looking forward to what he has to say, and we'll take your questions. So Mary, all yours.
Thank you, Sean. So, as Sean mentioned, I am the managing director leading our Accenture Technology Labs within Silicon Valley, and Accenture's Tech Labs are really the research and development arm of Accenture. So I'm very pleased that you're here to join me today for this important economic conference. For those of you who are not familiar with Accenture, we are a technology consulting and outsourcing company. So we really bring together unparalleled experience. We bring together comprehensive capabilities across all business industries and business functions. And we also bring together extensive research on what makes some of the world's most successful companies successful. And so we bring all that together to work with our clients to collaborate and help them become high-performing businesses and governments. So, what this really means is that we're delivering business and technology solutions to help make our clients become more profitable and to help them grow their businesses, right? And that eventually leads to economic expansion, which is something we're very committed to. Within our Accenture Technology Labs, we've actually been turning innovation, technology innovation, into business results for over 20 years. And that's something that, I think is really important. It's especially in the Bay Area here. We're taking new and emerging technologies, and we're looking at how we can apply those, how we can identify new opportunities for our clients to break new ground, right, and to jump ahead of their competition. And that's something that ultimately creates opportunities that will stimulate our local economy, right? If our clients here in the Bay Area are able to leapfrog competition by using technology, by using new ways of bringing that technology to their business, that's going to benefit all of us. So just as the Bay Area Council Economic Institute is dedicated to supporting economic competitiveness and vitality here in the Bay economy, so are we at Accenture. In order for us all to thrive, we need to understand the economic environment that we're working in, and we need to think about how to apply that to make sound business decisions that affect all of us and that will lead to economic expansion here in the area. So with our sponsorship of today's conference, I hope that we will bring you the most up-to-date and relevant information to help all of you make those decisions as 2015 unfolds ahead of us here. So at this time, I would like to introduce John Williams, President and CEO of the San Francisco Federal Reserve, and thank you for hosting us here today.
Thanks, Mary, and thanks, Sean. I think the San Francisco Fed really enjoys and appreciates our connection with the Bay Area Council and obviously with the Bay Area Council's Economic Institute. They're doing great work, and we're really happy and proud to be involved with this and hosting these programs. As I'm going to use about 10 minutes, given the time schedule we have, to give kind of what I view as the 30,000-foot view of monetary policy and the economic outlook for the country as a whole. Fortunately, I'm followed by speakers who are going to be able to give a deeper dive into the national economic outlook and also the regional economic development. So I'm going to kind of give you the view from a monetary policymaker, how I think about personally, view the economic situation and how to think about monetary policy in terms of that. The first thing I'm going to say, I thought this was going to be a forecast, but it's now just reading the news headlines. 2015 is going to be a very interesting year for monetary policy. And I think one of the things that all of us should be aware of, and the events that have been happening in Europe and Switzerland now, I think underline a point. In a way, a lot of the attention's been on in terms of monetary policy, has been around what the Fed's going to do. But really, it's what's a much bigger story is what's happening globally. What's happening in Japan in terms of their policy initiatives, what's happening in the European Central Bank, European economy, their policy initiatives, and obviously how that spills over to other countries around the world. So let me talk about how I think about monetary policy and the economic outlook. The Federal Reserve has a dual mandate. The dual mandate is maximum employment, price stability. So those are our goals in terms of monetary policy, and what we try to do is set monetary policy in a way, set interest rates and our other policy tools in a way that helps us best achieve those two goals. Most of the time, those goals are consistent with each other. There's no trade-off that we have to face, but sometimes there can be trade-offs, and we have to weigh the two goals and take a balanced approach to achieving both of them. Right now, let me talk first about employment and our maximum employment mandate. Congress gave us the mandate, but didn't say what it meant. They said maximum employment. So we have to infer or determine on our own, using economic analysis, how to think about what maximum employment means. And typically economists, and myself included, think about maximum employment in terms of the unemployment rate. So what we think of is that the economy has a normal, when it's at full strength, when the U.S. economy is at full strength, the unemployment rate on average is about 5 to 5.5%. And my own, staff and our view is that I would get very precise here. There are a lot of reporters in the room. Is the 5.2% unemployment would be a normal unemployment rate for the U.S. economy. So let's think about, that's one of our goals, something like 5.25% unemployment. So unemployment rate nationally is 5.6%. It's come down from 10% following the Great Recession. It's come all the way down to 5.6%, which is an amazing and really positive development. In addition, we've seen significant job growth over the last couple of years. We've seen a really improving labor market and economy domestically in the U.S. And that means that in the end we're getting pretty close to this full employment mandated goal. Now we look at a lot of labor market indicators, not just the unemployment rate, but just when you look at all the different ones, you get the same story. They're all improving dramatically, and all of them, in my view, will be at kind of full employment levels, based on the unemployment rate or other indicators of the labor market, either by the end of this year or maybe early 2016. So from my perspective, having been in this job now nearly 4 years, this is a very, very welcome day that I can say that within the next year, at least according to our forecast, the way things are going, we're actually finally achieve our maximum employment mandate, meaning unemployment will be down to the low fives for unemployment, and other indicators will show that the labor market is very strong. So from that perspective, I think things are very good. I think the underlying momentum of the economy is good. I think the decline in oil prices, net, I think we have to do 4 nets when you go through all the oil price effects in the economy. After doing all the analysis, the decline in oil prices is a positive for growth in 2015. Basically, it's like a tax cut for consumers. It's a huge benefit to businesses who use a lot of energy. And of course, it reflects in large part, it's hard to know exactly what percent of the decline in oil prices is supply and demand, but a large part of it is the supply, the increased supply because of developments, especially in the U.S. around type oil or fracking, and obviously natural gas similarly. So those are all very positives for U.S. growth, and if you were asking what keeps me up at night, it's really not going to be, the issue of is our economy on a good track, good momentum going into this year. I feel good about that. So what's our second mandate? That's price stability. When we define that again, we have to define that because Congress didn't tell us what that meant. But we define that to be a 2% inflation rate over the medium term, not every month, not every year, but on average we want 2% inflation based on the Fed's preferred broad index of consumer prices. So currently, that's running a little above 1%, and that reflects well below 2%. It's been below 2% for the last few years. Reflects, I think, 3 factors right now. One is the labor market, the economy still is not quite back to full strength. Wage growth has been really modest over the last few years. Price pressures from the domestic economies remain modest. So we still have a ways to go in getting to full employment, as I mentioned. We have another year or so to go. But with the U.S. economy improving, I expect wage pressures to build, domestic price pressures to get back to more normal levels over the next year. More importantly, for the near term are 2 important developments, and they both deal with commodity prices and global economic developments. Japan, Europe, China, biggest economies in the world outside the United States have all have disappointment in terms of economic growth, in terms of inflation. So except for the U.S. and a few other countries, the global economic outlook has definitely worsened. What that has done is led to strong policy actions in Japan by the Bank of Japan and the Japanese government to stimulate their economy. And in the European Euro area, the European Central Bank, there's a big debate about what will happen and when, but there's a strong sense that they're going to take stronger actions to stimulate the economy through monetary policy. So what happens when you have a weakness abroad and central banks, they're trying to stimulate their economies? It does cause their currencies to fall in value versus the dollar. I would actually argue it's about the decline in the euro and the yen versus the dollar rather than a strong strengthening of the dollar. It really reflects the conditions in those countries more than conditions simply in the U.S. So what that means is the U.S. dollar has increased in value significantly. That's caused lower import prices for whether it's fuel, but more generally for anything we buy from abroad has gotten cheaper, and that's pushed down U.S. inflation. Finally, there's oil, and that's having a huge effect on U.S. consumer prices because energy is a significant part of the consumer's spending basket, and as those prices have come down so sharply, inflation has come down with it. If you saw the CPI this morning, or even over the last 6 months, inflation is running very, very low, in large part because of this energy thing. So as a policymaker, we have to be very careful about not overreacting to short-term fluctuations in commodity prices or even import prices and things like that. And so what we try to do, and what I try to do, is to take a 1 to 2 year ahead perspective on what's happening in inflation. Similarly, like I mentioned on unemployment. Monetary policy, as Milton famously said, has long and variable lags. And the lag, typical analysis would say monetary policy takes a year or two to have its fullest effect. So what I'm doing as a monetary policymaker is sitting there thinking, okay, given what's happening in the U.S. economy abroad, what's happening with all the different factors I talked about, oil prices, what's that mean for the U.S. economy really in 2016 and 2017, not so much what's happening right now. Where are we, what's the path we're on, and what's the right monetary policy given that path? So looking through that, I think our experience shows that commodity price swings leave an imprint on inflation in the short run, but over the medium term do not affect underlying inflation rates. We also know the dollar movements have a similar effect. They obviously affect inflation in the short run. Over the medium term, they don't seem to leave much of an impact. So when I look at, what I try to do is look at underlying rates of inflation. That means not just the month-to-month movements, but kind of the trends underlying, and there's a bunch of different measures or ways to do that. Famously, that economists are accused of neither eating nor driving. We look at core inflation, which excludes food and energy, but we actually do eat and drive. So there are other ways to do this, and those measures are about 1.5 to 1.6%. So the positive sign I see when I look at the data that strips out some of the volatility, we can look at the underlying trends, is an economy that's improving, actually getting stronger and improving, and an inflation trend, again, that's actually about 1.5%. And I think as the economy improves, as we get through this next year of the effects of energy prices and commodity import prices, inflation is going to move back towards 2%. So fundamentally, there's a lot of things going on in Europe, Asia, South America. There's a lot of international developments that are affecting the U.S. economic outlook. Some of them are positive, lower oil prices. I think that we have good momentum in the U.S. economy domestically. Some of them negative in terms of global demand growth. But overall, my view is the economy is still on a very good track. I expect growth to be between 2.5% and 3%. That's real GDP nationwide. And expect unemployment to keep coming down and inflation to move back. So looking through all of that, what does that mean? Well, it means that personally, speaking for myself, I actually think that it's still appropriate for us to start the process of normalizing monetary policy this year. Normalizing monetary policy is a code language for raising interest rates. In case you missed that. And the exact timing of that is going to depend on the data. But I do think that if my forecast comes true, if things have evolved more or less as I see, I think that sometime around the middle of the year, we're going to be closer to a decision, at least I would think we'll be closer to it would be an appropriate timing to raise rates. Now, maybe, the data will push us a little bit further one way or the other, and obviously there's going to be a lot of discussion and debate around this. I'm not making a prediction of what the Fed will do, but I think the good news here is that we are in a very, economy's improved a lot. We're in a pretty good place, and the fact is we were able to start adjusting policy, tightening policy in a way because of that strength and that strong position. Of course, it's going to be a very interesting year in terms of global events. So I'm going to watch the data, and decisions will be based on what actually happens, not just on what our forecasts are. So I think that's my summary. I don't know. Sometimes I say it's 30,000 feet, sometimes 60,000 feet. Some people say that there's actually no oxygen at the level you speak. Anyway, that's kind of my summary of the economic situation, kind of how it plays into monetary policy. And I'm happy to take anybody's questions. And Sean's going to cut me off when the time runs out. Sure.
Any comment on that U6 unemployment rate?
Sure. So the question, I'll repeat the question. So the question is about U6 unemployment rate, and I give Janet Yellen credit for this. The fact that people now talk about U3, U6 as if this was like normal lunchtime conversation, as opposed to a very technical aspect of this. So U6 is the broadest measure of the unemployment rate. It includes not only people who say they're unemployed, but also people who are part-time, working part-time, and say that they would like to work full-time for economic, but because of the situation in the economy, they can't work full-time. It also includes people, some of the people who identify themselves as no longer looking for work because they've kind of given up. The U6 is running quite a bit higher than U3, meaning that there is a broader measure of unemployment is higher. Two things I would say to that: it's come down a lot, like the other measures of unemployment. It's really improved a lot over the last 12, 18 months. Second is the real thing that's still sticking, and we're watching, I'm watching carefully, is this part-time for economic reasons. That's the one piece of the U6 versus U3 that's still staying higher. Trying to understand to what extent is that reflecting the weakness in the economy, to what extent does that reflect something structural, maybe the employer isn't really, or designing the jobs differently. My own view is we're going to see, with the economy improving, all of these measures, U6, U3, and the others, come down to more, whatever the new normal or the normal levels are in the next year, year and a half. Sure.
Curious question from my perspective. Low interest rates stimulate borrowing and kind of disincent savings, and the effect on the stock market, a lot of people have said, has been where else do you put your money? How does the Fed look into markets like that? And I mean, you kind of focused on price stability and employment, but markets, is that part of the price stability aspect that you guys are looking at? And curious how you think.
Let me repeat the question very briefly. It's like, I talked a lot about employment, unemployment, inflation. Didn't talk about financial markets, didn't talk about the stock markets, bond market. Don't we count that as part of price stability and the difference about the housing market? So the answer is no. Price stability that I view of as the price of goods and services that people consume, not asset prices like stocks or prices of houses. Now the price, the CPI and the other price indices, they include the cost of renting houses, including those who own their houses, but it doesn't include the price of the house. So when the prices went up, way up and down and up, that's not part of that. I think that the way I view this is that asset prices like those are part of the way that financial markets work. They reflect expectations of the future, they reflect economic conditions, and they're important indicators of what's happening in markets. They're important drivers of consumer spending and things. But we're not, in my view, we don't want to focus on them as like goals or something that we want to see the stock market do better or worse. What we want to focus on is really how can we influence financial conditions broadly to achieve our economic goals. So, in my view, the stimulative monetary policy, of course, has caused bond rates to go lower, the stock price to go higher, helped housing prices to recover. That's part of the normal monetary transmission mechanism. But it's not a goal unto itself. It's really something that happens when monetary policy acts in the way that we have. When we normalize monetary policy, get back to normal interest rates gradually over time, those effects, of course, will diminish. And so I think that everyone has to understand, when the Fed eventually does start raising interest rates, and that happens, that's going to obviously influence bond rates, mortgage rates, and other asset prices. And that's just part of the normal transmission mechanism. Sure.
You've spoken of international influences on our own economy. How would you comment about the slowness of the European Union and some of their challenges, as well as Russia's current challenges, politically motivated as they may be sometimes?
So the question was really about the challenges in Europe on their economic front, and also in Russia, but related to the political challenges. And I'll just say the obvious: it is much harder to conduct monetary policy in an environment like this in Europe than it is in the United States. In the United States, we have our asset purchase programs, our monetary policy programs have been buying government treasury securities, U.S. government securities, and mortgage-backed securities backed by agencies. So that's a extremely active national security market, and we're able to do that. In Europe, you still have, every country has its own government budgets and debt. There's a very different process around that. The other thing I would say in the ECB in Europe is it's still a very banking finance economy. So, you know, for QE to work, so the asset purchase is buying, you know, government securities at lower interest rates, that may not have nearly as much bang for the buck, if you will, as it did in the United States, where this is basically a capital-based, capital market-based economy. So I think they face a lot of challenges in Europe, both politically, but also, you know, kind of how their financial system works. And I think the important thing for them is to, you know, find the best way they can within that framework to stimulate the economies of the euro area, especially. I mean, euro area inflation is extremely low. It's kind of getting that scary, closer to deflation area. And of course, the economy is in general not doing that well. So, you know, I think it's imperative to find ways to stimulate Europe's economy, but it's harder to do than it is here, where literally the FOMC can get together and say, you know, let's just buy more treasuries. It's just more complex environment.
I wonder if you factor in wage growth in your calculations for the future, and in particular middle income wage growth. We hear a lot about average wage growth, but in this area it seems to be bifurcated. It's been only the tiny and doing somewhat okay. So could you comment on wage growth?
Sure. So the question was about how wage growth fits into this, and not only the wage of the median worker or the average wages, but more generally the distribution of wages. You know, lower paid workers, higher paid workers. So whenever I'm asked a question, and I'm being serious about this, have we considered something? I assure you we've considered it many, many times. We spend all of our time discussing, debating, analyzing every possible issue. With the briefing books of this high. On the wage growth, it's been a key part of the discussion. Why aren't wages picking up? You know, average wages, but also looking at what's happening across the distribution. And then, so what we think about is, what does that tell us about where the labor market is? What's that tell us about consumer demand? You know, most consumers are basically, you know, how big their paycheck is going to determine how much they spend. And obviously income inequality in general, how does that affect demand in the economy? How does that affect long-term prospects or short-term demand? So we do a lot of analysis around that. I would say the punchline of the wages is, especially if you're not looking at the very highest end, but if you're looking at, you know, the broad spectrum of wages, I mean, this has been a puzzling development that wage growth continues to be tepid. It's positive. Real wages actually are growing, inflation adjusted, but we would have expected by now more wage growth than, given how much the economy's improved. And there's a lot of theories about that. The San Francisco Fed, my colleagues have kind of pushed this this notion that there's this pent-up deflation. In other words, when wages didn't get cut during the recession, that meant that as the economy got better, they didn't rise. If they had fallen as much as, you know, maybe the economy would have normally caused, they would have rebounded stronger. But since they didn't get cut, they're not rebounding as much. But it's really an issue that we follow very closely, and not only for the short run, but kind of like the longer run trends for the economy. No, I'm sorry. I want to make sure I look both directions. So I'll go.
Aside from monetary policy, what other factors are driving the growth in the U.S. that is lacking elsewhere in the world?
Besides monetary policy. You know, monetary policy really is more about kind of getting through the business cycle and kind of the ups and downs. I mean, you know, the primary drivers, you know, it's kind of picking up on what Sean said. What the primary drivers of growth is going to be growth in the labor force, it's good growth in productivity. Where does productivity growth come from? It comes from innovation. It comes from new ideas, new ways of doing things, new products that nobody imagined. So here is where a big debate is going on. I was just at the American Economic Association meetings. That's where all the economists across the country, across the globe get together. It's, as you can imagine, a wild party. And I was there was a panel, a great panel. We had Larry Summers, Barry Eichengreen from Berkeley, Bob Gordon and Bob Hall from Stanford, Greg Mankiw, a lot of leading economists, and they were debating kind of what's the secular stagnation, which is this idea that Larry Summers has been pushing, that, you know, maybe we're going to get stuck in low growth for quite some time. And you know, the debate's going on. We don't know the answer, but there are issues about productivity growth trends globally have slowed. importantly, labor force growth has slowed a lot across the globe, but not only in the U.S. because of the baby boomers. In Asia, it's essentially negative growth. It is negative growth. The labor force, Korea, Europe. So there's a lot of questions out there about how does the global economy can maintain momentum when labor forces are shrinking, both because there aren't as many babies, but also because people are, baby boom kind of development. And what is the next big industrial revolution? So these are topics that are being discussed. When you live in the Bay Area and Silicon Valley, you cannot be a pessimist on these issues. It's actually physically impossible. So I'm in the optimist that we don't know what the next big innovation is going to be, but it's an interesting topic. There's way over here, yes.
I believe I understand you'll be a voting member on the FOMC coming up, a rotating position.
Yeah.
And you've indicated that you feel that mid-year normalization of monetary policy will start improving interest rates up. Do you feel that shared amongst your
So, I have like little instructions of what to say and what not to say. I don't pay attention, thanks. Could you have come up just 1 minute earlier? It's a great question. Seriously, everything I say is my own views. As the Federal Reserve 101 years ago now, was set up to have these independent voices of policy. I'm speaking for my own views based on everything I've learned from people I talk to, or economists and everything, and that's my own perspective. When we get together, the 17 of us, debate this, there'll be decisions made based on what's happening, where the consensus is, and I do not prejudge what that decision will be until we actually have those debates and discussions. But I will just say one thing. I keep saying this is what I should give people for Christmas, is t-shirts that says monetary policy, it's data driven. So right now it's January. What we'll do in June, September, whatever later the year, it'll really depend on what's happening in the economy, what's happening globally, what's happening in terms of our goals. And I just hope that you understand that whenever I say I think we should do this or that, it doesn't speak obviously for anybody else in the Federal Reserve System. Well, thank you very much, and I'm looking forward to the rest of the program.
Well, that was great. Thank you very much, John. That was refreshing, actually, not so Delphic. Putting aside the FOMC for a second. Sorry, my timing was so bad on that. So with that, really doing a wonderful job to set our stage for the rest of the morning, let's turn to our forecast. I'm not going to read bios because they're long and distinguished. You have them in your printed materials, but take my word, they're long and distinguished. Please read them. I want to thank the UCLA Anderson Forecast for being also our partner in this event. This is the 4th year we've partnered together, and the 4th year that Jerry Nickelsberg, senior economist with the Anderson Forecast, has come up here in Northern California to join us for this event. So Jerry's going to give a national and California forecast. Our vice president at the Institute, Tracey, Grose, is going to give you a picture of what's going on right now in the Bay Area's economy, and then they'll take your questions before going on to our panel. So we'll turn it over to you, Jerry.
Thanks, Sean, and thank you to the Bay Area Economic Council for putting on this event and inviting me once again, and to John and the Federal Reserve for providing the venue. So let's see, how do I do the slides? And there they are. Great, so I want to talk about the U.S. and California, and I'll do a little bit at the end on the Bay Area because we have produced a Bay Area economic model and do a forecast once a year, and our forecast has just been completed. And the title is, This Old World Still Looks the Same, from the Eagles song Tequila Sunrise, because if you look at this recovery, it sort of has been moving apace, getting better and better, slowly but surely, and but no kind of real big surprising moves. But as John said, relative to the U.S., relative to the world, it depends on where you are. And in the U.S., It also depends on where you are. The same is quite good in some places, like in California. So if you look at this chart, this is total employment, and it is November 2014 as a percentage of the pre-recession peaks. And Texas is there at over 110%. Next is Minnesota, Colorado, California, Massachusetts. There are a few others that you could put in here that are above that horizontal 100% line. But if you just take these 5 out, the rest of the U.S. hasn't recovered yet. So there's still a ways to go. When we look at California, you're going to see that in California too. So what do these states that are in blue here, I guess Texas might object to being in blue, but what do these states that are in blue here have in common? Well, it's not, so sorry, Governor Perry, it's not low taxes, lax regulation, and kind of all of the list of things that are ascribed to the Texas miracle. There's no correlation between those. What do they have in common? There are 2 things driving this economy: oil, or energy, and technology. So if you go left to right, Texas, technology and energy, and of course the falling oil prices, we're going to see how that impacts that growth rate. Minnesota, technology. Colorado, energy and technology. California, technology. Massachusetts, technology. That's what's driving the economy, and that kind of unevenness is why we have large parts of our economy kind of falling behind. So don't have too much time, so let me move sort of quickly through the U.S. This is our U.S. GDP forecast. We see the economy slowly improving, now moving up above average, but not by much. So a little bit more than a 3% economy going forward. As you can see, the blue here is actuals, and there's a lot of noise. It bounces around. But as we look at kind of the average growth rate, we're seeing still strength going over the next couple of years. So one of the advantages of having an economy that's growing slowly but steadily is you don't have as much in the way of buildup of imbalances. You don't have overbuilding of houses. You don't have over manufacturing of cars, where consumers get to a point where they say we've got enough, and then those industries have to contract. And that's kind of the basis for a longer run expansion than normal. One of the real pieces of good news in this expansion, and why we think it's going to be above a 3% economy, is that consumers are now more confident. So in the recovery up till now, consumers have been trying to push up their savings rates, nervous about the future, nervous about bad economic events. Savings rates are now in the 5 to 6% range, and that's a range where consumers, given all of the economic data today, seem to think savings rates ought to stay. And that means that consumption can grow, and consumption growth is 70% of GDP growth. So that's good news, and we're seeing solid growth in consumption. We expect that to be continuing through our forecast horizon. Housing is another area that we see contributing to economic growth as we go forward. We underbuilt housing for a long time. Now we're starting to get some growth. It's kind of stuck around the 1 million level, but we expect that to begin to increase over the next couple of years, but not to where it was before. It used to be that we thought that 1.5 million homes a year was what you needed for population growth and for replacement. But now with the demographics of today, it looks like that number may be in the 1.3 plus or 1.4 plus, so a bit lower. So we see it growing to about 1.4, and then as we move past 2016 and we've sort of made up some of the lost production, maybe backing off a little bit from that, but that still would be a source of growth. When we get to California, I'm going to show you that that's not as much good news in terms of employment as you might have expected, though. Equipment and software, and this is a key element, particularly here in the Bay Area. Companies today in this globalized world have to stay competitive on the world stage. That means that they're looking for productivity growth everywhere they can find it. and they get that through the purchase of equipment and software. And so we see that continuing, and we've got a 8.8% for this year and 6.6% in the following year. Could be higher than that. This is really kind of an important component of the new economy. But non-residential construction slowing down. So one of the things that that is not sort of commonly known about non-residential construction, because you think of office buildings, warehouses, retail, but it's also drilling rigs, and it's a big part of that. And with the fall in oil prices, the orders for drilling rigs have just plummeted. So non-residential construction is not really going to be a contributor this year to GDP growth, although we expect it to begin to pick up in 2016. And by the way, we have an oil price forecast which is higher than today's prices. I think probably everybody does. And the way oil prices have really plummeted. Our oil price forecast is that as we move out over the next couple of years, it's going to be about in the $80 range. So that this drop is sort of temporary, but it's not getting back to the 100 plus range that it was before. In terms of state and local governments, modest growth, not a lot of contribution, but some. It's at least no longer a drag on economic growth. And I don't have a slide here on federal government purchases of goods and services. That's been contracting. We'll see what happens with the Republican Congress now. There's pressure to increase defense spending, but is that going to be offset, or how is that going to play out? We have in our forecast little to no growth in federal government purchases of goods and services. Now, that's not transfer payments. That's just the buying of bombs and tanks and computers and all of the things that the federal government buys. So that means job growth in the 230,000 per month, and that's good job growth. That's more the steady job growth. We hit new highs in employment with that job growth. But there's sort of one kind of fly in the ointment here, and that has to do with the unemployment numbers. We had a question about U3 and U6. So I want to show you this slide. What you see here is unemployment by weeks of duration divided by the civilian population. So that's just to normalize it. And this is less than 5 years, this blue line. And if you look at, not less than 5 years, less than 5 weeks. And if you look at, so those who are unemployed less than 5 weeks, that's right back to normal. That's a complete recovery in that aspect of unemployment. The next one is 5 to 14, looks pretty much the same, fully recovered. And you notice the pattern, they sort of mock one another, they're highly correlated. This is 14 to 26, not quite back, but pretty close. And then we have over 27 weeks, and that's the historical record of over 27 weeks. And again, the pattern, very highly correlated, and they sort of sit one to another in the same kind of relationship. But beginning in 2008, you get that over 27 weeks just jumps up. You have something really different happening. And if you look at this, and by the way, the latest employment numbers, the latest jobs report for last December, which is a really good jobs report. If you read the press release, what it said was, oh yeah, and by the way, the long-term unemployed, the people on this red line, it's pretty much the same, hasn't changed. And you see this dropping, and you might say, well, that's good, those long-term unemployed are getting jobs. Not really. And this goes back to the U6 question. They're dropping out of the labor force. So these are people that we think are structurally unemployed. These are riveters who were laid off, and when they go back to get a job at the factory, when the factory is expanding, they say, well, what do you know about robotics? And so they have a mismatch of skills. There have been a lot of studies of this mismatch of skills, and the data is really hard to ferret out of the data what's happening there. But we are clearly in transition from an industrial economy to an information economy, and there are clearly people who are affected by this, and that's why you see this red line really in a different position to all the other lines. And so we can see that in another way, and I think this is kind of striking. The red lines here are recessions, so the red shaded areas, and the blue line is a ratio of labor force growth to population growth. So you'd expect that to be about 1-to-1, right? As the population grows, labor force grows at about the same rate. And you see it jumps up to about 1.5, so that's in the 70s and the 80s. This is the entrance of women to the labor force. And so you'd expect it to be more, and then it falls back to 1-to-1. That's where you'd expect this number to be. But since the Great Recession, it's been down, dropped below 0, but it's been down, say, about 0.5. That we're not getting labor force growth that kind of matches our population growth. Now, some of that is baby boomers retiring. Although labor force participation amongst baby boomers is actually one part of labor force participation rate that really hasn't collapsed. That we boomers are working longer and we're resisting this retirement pressure. A second part of this is simply changed tastes and preferences. That, and particularly amongst women and changed attitudes in the U.S. Now, what happened in the recession was that many two-earner families became one-earner families. And at least some of them, and there's a study by the Pew Institute which indicates that, at least some of them said, okay, so we've been one-earner families for a year, 2 years, 3 years, and actually we've learned to live with this and we kind of like it. This is sort of better than rushing in the morning to get the kids out to daycare, and so we like this, and we'll do without that extra income and without that those extra goods. So that's part of it too. But those are about 2/3, but about 1/3 of it is people who have just said, I'm a riveter and nobody wants riveters. And I'm 50 or 55, and what am I going to do going back to school to learn how to be that robotics technician? I'll get out at 57, who's going to hire me? So why is that worth my time and money? So we've still have a structural problem in this economy, and it doesn't look like it's going away soon. So upsides to the U.S. forecast, oil prices providing a stimulus, kind of our estimate, John said there's lots of ways you net this out. About $173 billion into households' spending power. More if oil prices stay where they are today, but given our forecast, it's about $173 billion stimulus, but you have to net that out because we're a big oil producer, and there's about $100 billion that would be going into the hands of those who are producing oil, and so you net it out as maybe about a $73 billion stimulus. But this stimulus, unlike the Bush and Obama stimulus, doesn't affect the federal budget. It's like a tax cut without the loss of revenue for the federal government. So it is a real boost to the economy, and that's going to provide this year some strength. And that's why you saw in this year's numbers a little faster growth than 2016. John talked about more normal financial markets and our forecast. So he wouldn't say that we're going to do this in June, whoever asked that question. We're saying he is. So that's in our forecast is a movement in interest rates in June and moving towards this more normal financial markets where the market is determining interest rates more than the massive intervention of the Federal Reserve in order to stimulate the economy. So that's an upside. In this slow growth, as I said, fewer imbalances. Now, of course, there are some downsides, and I think the principal one, and it does really relate to what Sean said about the Bay Area economy, is that we're not overbuilding houses, we're not building too many cars. But there's a third element that causes business cycles, and we saw the real hint of this in 2000-2001 with the 2001 recession, and that is technology adoption. That also goes in waves, and at some point firms say, okay, we've got enough. and there are no new technologies, and then you get that cutback. And since technology, as you saw in that first slide, is one of the drivers of this recovery, that's a downside risk. Now, we think that there's enough new stuff in the pipeline that technology adoption is going to continue and going to continue for some time. That has some real legs to it this time, and we don't have kind of over purchasing of technology like you saw with computers in the late 1990s. So we're not there yet, but it is a downside risk. Turning to California, again, some familiar trends. This is Southern California. So non-farm payroll employment, we're 1.3% above the peak. So we have been since the depths of the recession, steady economic growth, but we want to temper that a little bit. This is the average growth 1990 to 2007, and as you can see, we're not there, and given our forecast, we're not going to be there at the end of 2016. In fact, at the rate that we're growing, good as it is, we won't get there till about 2020 or 2021. And so part of that is people dropping out of the labor force, but we still have a great deal of potential job growth here in California. The job growth that we've seen is well distributed among sectors, healthcare and social services, administrative services. Now, that's where the temps are in administrative services, but the temps today mean something different than it used to. Temps used to mean Kelly girls. Temps today are accountants, are lawyers, are architects, are software engineers. And so temp jobs are not necessarily low-wage jobs. They just have a different employer-to-employee relationship. Leisure and hospitality, that's where the low-wage jobs are. There's often sort of a comment that, oh, well, we're growing this economy on leisure and hospitality. We lost a lot of unskilled jobs during the Great Recession, and those folks didn't get high skills in the meantime. So they need jobs too. So it's not necessarily a bad thing that we have good growth in leisure and hospitality, professional, scientific, and technical. And you go all the way over the right, where are we still losing jobs? And it's non-durable goods manufacturing, federal government, and we have, so this is a little bit unusual. Over the last year, we've lost jobs actually in education, but a big part of that is the change in federal loans to private technical schools and private for-profit universities. So you had a cutback there. So that's kind of an anomaly. But as uneven as the U.S. is, so is California. So these are counties in California, and the blue are coastal counties, and the red are inland counties. And you notice the blues clustered over the left, that horizontal line is fully recovered. There are only two counties that are shaded in red that are, excuse me, fully recovered. Kern County, what's the story in Kern County? Well, that's energy, that's oil. Merced, why would Merced be there? Well, it turns out that in Merced, the losses in manufacturing and construction and retail, numerically, have been just offset by the gains in the expansion of UC Merced. So that is a statistical anomaly because I don't think the retail clerks have been hired by UC Merced. So it's different people, different skills, but numerically fully recovered, which is why you really have to look behind the numbers. The ones that are lagging behind, Santa Cruz, Los Angeles, and Orange County, and the two significant there ones are Los Angeles, which is really a mixed economy between an inland kind of economy of traditional manufacturing, lots of non-durable goods manufacturing, including the only real garment industry in the U.S., as well as West LA, what's now being called Silicon Beach. And in fact, if you separate out West LA, it looks very much like Silicon Valley or San Francisco in terms of job performance, which means the rest of Los Angeles County doing rather horribly. Orange County, huge losses in the financial industry in the Great Recession, and though Orange County is growing at a good rate, they have a long ways to come back. But other than that, you can look at the geography. Inland California, still doing poorly and doing worse than the U.S. Coastal California, doing great and growing faster than the U.S. And of course, the Bay Area, really the star performers. In terms of housing, we had some concern about a new housing bubble. This is median home prices, FHFA numbers, but no matter what housing price index you use, you get the same result, that housing prices have now kind of leveled off. That appreciation was really just a correction to an overcorrection in home prices. We're now back to 2004 in nominal terms, which means that if you invested in housing in 2004, a decade ago, you would have earned zero, and with inflation, you would have lost money. So that's not home prices that are in the bubble range. What is happening significantly in housing in California is we've really worked through the foreclosures. Foreclosures are now down to about 6%. If you add in short sales, it's 11% of all homes sold. And that may sound a little high because in 2003, 2004, it was 8%. But we're only selling about 2/3 of the homes that we sold then. So those are about the right numbers for a market that's really normalizing. So we get a normal market, normal price appreciation. That gives builders the confidence that they can make a business plan that allows them to build new homes. But there is something different happening, and that is single-family versus multifamily housing. And this is single-family housing permits as a percentage of the total, and you notice that it dropped below 50% once. That was a tax incentive during the S&L boom days that was expiring for the building of apartments. But other than that, single family has really been the dominant part of home construction in California until today. And this is really a change in tastes and preferences. And that's important as we think about construction or the housing market as being a driver of California growth. And so if you take the number of full-time jobs per home built, and it's different for multifamily housing and single-family housing, multiply it by permits, you get this chart that shows you the employment, direct employment, not indirect employment, not managers, direct employment per unit of home built or permitted in California, and you can see the boom and bust and the slow growth. But it takes a different number of people to build a multifamily unit than a single-family unit. In fact, it's about 30% the labor. So if we went backwards and said, suppose, we're going to do a thought experiment, suppose all along we had the same mix of about 50-50 single-family to multifamily homes, how many construction workers would we have employed here in California? And that's this red line. That difference is between, depending on how you count it, between 10 to 15% of all construction jobs in California. So going forward, we expect the same mix because that's where demand is shifted. That's where tastes are. People want to live closer to work, and work is in these dense coastal areas. That means multifamily housing. It means that 10 to 15% of all construction jobs in California are gone for the foreseeable future. And so we're not going to get as much of a bang for the buck with new home construction as we had in the past. So now, Bay Area model, I told you that we've started doing this. This is the 4th annual one, and we do it in conjunction with this conference. Bay Area, and by the way, these slides, as well as the forecast for the Bay Area, are going to be available on the Bay Area Economic Council website, so you can go to that and get them. So I won't dwell too much on the numbers, but just the trends. Employment, we expect that to continue to grow. As I said, we think that this technology boom really has legs, and that means Bay Area employment is not just at a record as it is now, but it is going to be as a record even looking back to the heyday of the late 90s and 2000, that we're going to exceed that. And that means people coming into the Bay Area. It means, unfortunately, higher rents if you're a renter, higher home values if you're an owner, so that's not unfortunately, but more people coming in, more growth in the Bay Area. Unemployment rate coming down, and our forecast is it's going to be in the 4%, low 4%. So that's really getting back to where we were in the 1990s. Sort of a long recovery from the 1990s with a big recession in the middle. In terms of our forecast for 2015 and 2016, again, outperforming California, California outperforming the US. Okay, so I've said all of that. So let me move to the California forecast, so normally the numbers, if you're looking at the top line, they don't come out the same. I didn't use a ruler for this, but they did come out the same, about 2.2% each year, and that does outperform the US, which is about 1.8 to 1.9. Unemployment rate in California coming down, it's going to be about 5.3% by the end of our forecast period. The average for 2016, 5.6%. Personal income, good growth in personal income and in housing permits. And since this is a forecast, I want to leave you with this picture here. I teach a course on international business in China and a course on business forecasting at the Anderson School. And so I came across this. This is from the Shang Dynasty in China. So this is about between 1200 and 1600 BC. They used to call these dragon bones. They changed it to oracle bones because they got embarrassed, I guess, about dragons. And it has writing on some of the earliest writing, earliest Chinese writing. These were forecasts. And what they would do is they'd make the forecasts on those bones. They'd write them there, and then they'd take a hot poker and they put it into the bone, and the bone would crack, and you see the bone cracks there. And we haven't advanced that much today. It's just, we call the hot poker econometrics. And with that, take all forecasts as our best guess, what we think is the most likely. But there are risks in the forecast, upside and downside risks that one has to consider. And by the way, the Chinese during the Shang Dynasty, on the back of these, they wrote how well they did. It's something that I think we economists today could also benefit from. So I will close with that.
It's boomtown again in the Bay Area. Our roads are packed, housing is scarce, and increasingly costly. In many ways, the current upswing is broad-based. We're seeing job growth across industries and across the region. In other ways, excuse me, let me get the slides up. Somewhere. Great, thanks. In other ways, the current upswing is not being enjoyed by many segments of the community. The housing crisis and increasing income disparity, those are not just problems faced by individual families. These are issues that are impacting how well positioned we are for the future. And for certain, our investment in infrastructure has not kept pace with the region's growth. And it limits our potential for growth in the future. So let's take a look at the character of the current expansion. And in this time of plenty, how should we be thinking about how to prepare for the next downturn and also for the next expansion? So looking at November employment, we have reached the peak of 2,000. Over the 12-month period, we added 114,000 jobs. With a growth rate of 3.3%, the region is outpacing California at 2.3% and the nation at 2%. Jobs and information expanded by nearly 7%, construction jobs picked up by over 6%, and professional services by over 5%. And sectors hit especially hard during the downturn Sectors hit especially hard during the downturn, such as architectural and engineering services, are seeing strong gains now. Even manufacturing is growing in the Bay Area. And stay tuned for some surprising findings from a report we'll be releasing in the next few months on advanced manufacturing in California. We're very excited about that. Freelancers are on the rise. So since 2002, we've seen an increase of nearly 30% in freelancers and partnerships, but total employment has increased only by about 5% over that period. Driven by new technology platforms, changing preferences, and in some cases necessity, this is a diverse group. It includes those who are in between formal employment, also those highly skilled professionals who crave greater flexibility to go in and out of their own projects, certainly also general contractors and others. Non-employer firms equate to about 18% of the region's employment. And related to this, the Institute will be completing a report later this year that will examine some structural shifts in the labor market in the region. GDP growth in the region is outpacing that of most metros in the US. The San Francisco-Oakland Metro moved from 8th to 7th place in the nation between 2012 and 2013. The San Jose Metro ranks 17th. So combined, the two major metros report a GDP of about $548 billion. So if we were a country, we would be ranked 24th in the world, right between Poland and Argentina. Commercial space is hot. In the South Bay, the office sector's availability rate dipped below 13% for the first time since the first quarter of 2001. We'll be hearing 2001 again later on other measures. New demand for industrial space is also being seen in the South Bay. There was about 1 million square feet of new leases in the third quarter of 2014. Big leases in the South Bay include 23andMe and WhatsApp. In the East Bay, office space demand from San Francisco continues to feed into downtown Oakland. Walnut Creek's Class A asking rents are approaching historic highs. Office rents in Tri-Valley continue to go up even with the exit of AT&T's headquarters from Bishop Ranch. And there's new demand for industrial space as well in Tri-Valley. And we've got vacancy rates hitting an all-time low in the third quarter of 2014. In San Francisco office rates are the fastest growing in the country, and we have now edged out Manhattan as the most expensive office market in the US. One major lease is just next door. Google signed a new lease for 243,000 square feet of office space at One Market. Our innovation economy is going strong, and the Bay Area accounted for 7.6% of all US patents registered in 2013. And this is the largest share ever, and this is looking at data going back to the 1970s. And our collaboration with foreign partners is continuing to rise. So nearly 12% of all patents that include a Bay Area inventor also include an inventor from outside the country, and that is good. That is good for innovation. As of the third quarter of 2014, venture capital investment in the Bay Area reached $17 billion. This is 40% above 2013 for the full year, and it also equals total investment in 2001. So that means after we see the final quarter for last year, for 2014, it will put us above that heady territory you see for 2001. So it was the second quarter of last year that witnessed significant investment, placing the year ahead of 2013. Top deals included Uber, Airbnb, Lyft, and Pinterest. Other top deals last year included Palantir Technologies, House Inc., and Box Inc. Income disparity is a growing threat. Over the last 15 years, GDP growth in the US has not translated into growth in middle incomes. Looking at income growth nationally from 1979 to 2010, the top 1% of earners saw incomes rise by more than 15%. For the bottom 90% of income earners, incomes rose by less than 1%. Why should we care? This is not simply a moral and political question, this is an economic question. radical institutions like Morgan Stanley and Standard & Poor's are voicing concern about this. According to Morgan Stanley, 3 of the main causes of growing income disparity include the growing proportion of poorly paid and insecure low-skill jobs, the rising wage premium for education, and the fact that tax and spend policies are less redistributive than they used to be decades ago. Standard & Poor's recently lowered its growth rating for the U.S. as a result of growing income disparity. And they expect lower state tax revenues coming out of this trend. If this happens, we can expect to pay more for public investment in roads, schools, and bridges. Median household income dropped 9% from 2008 in the Bay Area and 10% in California. Here we go. And you'll see, looking at the Bay Area in blue, there's a peak of 2008. You'll see we saw the downturn after 2000, and then median household income rose up to 2008. We had a downturn, and we're not seeing median household income rise with this current expansion. And we're seeing a squeezing in the middle. So households with annual incomes between $35,000 and $99,000 fell from 42% of households to 38%, while households in upper and lower ranges expanded. Let's see, the next one. Average wages rose 0.1% in the first half of 2014 in the Bay Area. California, statewide, we saw wage increases of 2.8%. Now, within the region and across industries, there's significant variation. San Francisco topped the region with incomes rising 7.3%, and Santa Clara 4.5%. Income increases have increased at the financial services and professional services at the top. We've also seen wage increases with transportation and manufacturing. Housing prices are up in the Bay Area by 14%, outpacing statewide rise of about 11%. Rents are up in the region by 9%. And this is just looking at buildings with 50 or more units. So that's a very specific set. So this map was produced by RadPad. They produced this map illustrating the cost of one-bedroom apartments along BART lines. And they see this as much an indictment of public transportation as of rent inflation. As Jerry said, preferences are changing. People want to live closer to work. They want to live closer to public transit. And so that helps push up the cost of those sites. More than 50% of Bay Area renters spend more than a third of their incomes on housing. So it's over half of our renting population is considered burdened by housing costs. And apparently we have overtaken Manhattan on this measure as well. According to the apartment rental site Zumper, San Francisco has edged out Manhattan as the country's priciest city for apartment rents. The best chance of moving up the economic ladder is through education. We know the cost of higher education is rising rapidly, but how are we doing in preparing our youth for success in an increasingly competitive world? As a whole, the region is making progress across most ethnic and racial groups, but we do know there are great disparities geographically across the Bay Area. Hispanics make up 23% of the region's population, but only 30% of Hispanic high school graduates are qualified for college. A better educated population raises everybody to a higher level of prosperity. Growing income disparity weakens progress in raising educational levels. Continued deterioration of education transmits educational disadvantages across generations, and this undermines the region's economic competitiveness going forward. The region's growth looks to be exceeding ABAC's projections for jobs and population, and transportation infrastructure investments in the Bay Area have not kept pace. The total number of cars and trucks on the road in the Bay Area is well above pre-recession levels. The region's 10 worst commutes are shifting as the housing crisis shifts people eastward. As congestion rises, average speeds fall. Over 20% of commuters spend more than 45 minutes on the road to work in 2012. Now, over 10% of commuters use public transportation, and BART ridership is up 17% since 1998. Given our geography and dependence on bridges, we have limited options for redundancy when disruptions arise. The Institute is currently interviewing businesses on how BART outages impact their operations. So if you have a story to tell, please let us know. The Bay Area has many advantages going for it. It has many advantages over other places in the world. In this time of plenty, we should be thinking about how best to plan for the next downturn, as well as for the next expansion. How can we develop greater resilience to withstand the next economic blow? And how would we like the next expansion to be different? And according to the Intergovernmental Panel on Climate Change, we now have irreversible impacts of climate change with which we need to contend. There's a lot we can do to drive regional economic prosperity in a holistic manner. The public sector needs healthy revenue streams to pay for services and critical infrastructure we need, and which we require to remain competitive in the future. In addition to public transit and roads, we need to invest in communications infrastructure in order to compete in the global economy. Ensuring that our economic growth is also building a strong middle class will go a long way in enabling success. And of course, outside of a centrally planned economy, we cannot simply decree the creation of more middle wage jobs. What we can do, however, is make the investments we need for ensuring our future prosperity. This means providing access to high-quality education, pre-K through post-college, as well as technical training, and as employers thinking about career paths and continued education. And it also means making the investments in public transit and other infrastructure now to position us for success in the future. Thank you.
So we have a few minutes before going to our panel for any questions that you want to ask Jerry or Tracey. So I'll just ask them to stand up here, and when we move on to the next, I'll raise my hand and we'll go to the panel.
Yes, question.
Jerry, you basically said that if oil prices in the mid-40s, give or take today, they're going to be in the 80s in the next year. What kind of forces are going to basically cause oil prices to double?
Well, I think you need to look at those oil prices and kind of that volatility as having a lot of expectations and nervousness embedded in that. And as China starts growing again, so you look at China says, well, we're only growing at 7.3%, but of course they make up the numbers. So if you look at Chinese manufacturing, you wouldn't come to that conclusion. As China starts growing again, as Japan starts growing again, as the Eurozone starts growing again, we're going to see increased demand for petroleum. And as the buyers and sellers of these contracts in the market become less nervous, you'll also see a firming of the price. So we might be wrong. It might not be 80. Maybe it's going to be 70 or 60. Bad for U.S. energy independence, good for U.S. households, more stimulus. And so perhaps we're a little bit on the conservative side, but there are a lot of forces that say 40 is really not the equilibrium value. Question?
Yeah, on your chart or your list of the five states that were above the last peak, I understood 4 of them: California, Colorado, Massachusetts, and Texas. I didn't quite understand Minneapolis, but I also didn't understand the ones that weren't there: Washington, Florida. It seems like they're the coast states. I would have thought would have been on the list. Are they like right behind and coming from behind, or why weren't they on the last peak?
Sure. So why is Minnesota there? Well, the Twin Cities has a really dynamic technology sector. and that's what's driving Minnesota. And of course, in terms of population, it's all in the Twin Cities, really, in the state. Why isn't Washington there? Well, Washington and Oregon have done fairly well because they have big technology sectors, just not as, the chart's kind of limited, but why isn't Florida there? Florida of late has been growing, but Florida's payroll employment is not back to its previous peak. And so that's why they're still in the other category. It really is mixed. Of the states that had a big crash in housing, California is really the only one that has this long, sustained recovery. Arizona's starting to get there, but that's really because of what's been happening in California. Again, this is all technology driven within states. So in Washington, Seattle, booming. Washington as a whole, a little bit further behind California. Okay, other questions? Or did we answer all your questions? Yes, question.
I've got a question for Tracey. Thank you for bringing attention to the question of shared prosperity. It seems obvious what one could do about that at the national level with fiscal policy or at the state level. What kind of levers do we have in the region and within our municipalities to make a significant difference in that area?
Our colleague Linda Gallagher would have a good answer for that. So Linda is doing important work, as you know, bringing together local employers and the workforce development infrastructure, if you will, of the Bay Area to better connect workforce needs and skills in the region. So, Mike, there's a lot we can do, and I'm looking forward to seeing how Linda's work on that front progresses.
Obviously, the California revenues are going to go up as the Bay Area is getting stronger. Is the state going to be working on maybe more infrastructure type projects for water and for transportation, and how is that going to affect the Bay Area in particular?
Right, so let me address the state first. State revenues are going up because state income is going up, particularly amongst those who fund the state, which is the highest income earners. There are some clouds on the horizon because Prop 30 taxes are going to expire. The income tax in 2018 and the sales tax in 2017, and the state has to make plans for not having that revenue. And so, there's some limitation as to what the state can do vis-a-vis infrastructure with current revenues. It's still struggling on how to pay for education and restoring some services and so on. So I don't expect a lot from the state except for as financed by bonds such as the water bond that just passed. We have lots of infrastructure we need to build in California. We're going to need to pay for that over time as that infrastructure is used, and that means bond issues, so that's really a question of whether or not the voters want that infrastructure.
I would only say that had we won the Olympic bid, we would have been a lot better off with our infrastructure development.
But one other comment on infrastructure. A lot of the infrastructure that we have in California, and infrastructure needs that we have in California, are not financed by the state. So, for example, utility infrastructure, which is an area that has been booming, that's not state financed. And some of the levee repair and refurbishment that's been going on in the Delta, privately financed. So we're getting a lot of infrastructure that's not state financed.
Last question.
I think I saw the number of $17 billion of venture capital money in California, and I was wondering how much that played into your 2015-2016 forecasts, and how that, affects not just the Bay Area, but also California in general.
Yeah, so, right, so the 17 billion that Tracey talked about is just the Bay Area. and in Orange County and in San Diego and in Los Angeles, you know, the number's been quite small, but it's been growing dramatically of late, particularly in, as I say, what's now being called Silicon Beach, which is the area between LAX and about the middle of Santa Monica, where there's a lot of startups and a lot of new venture capital. How does that play into the forecast? You know, I said that we think this tech boom has legs, that there's a lot more technology adoption that companies want to do. That means they will be demanding these goods and services from California companies. And for those companies to get started and to keep going, they need the capital. So it definitely plays into it. Not explicitly, not in some statistical model, but certainly, you know, intuitively, and does this forecast make sense? The notion that capital that will fund the expansion of those startups is certainly there in the forecast.
Thank you. Thanks very much, Jerry. Lucid as always. And thank you, Tracy. We're going to go to our final part of the program this morning now, the panel. And I think you'll find this a really interesting discussion. It's no mystery to any of us that we're living in a more and more connected world. The role that's played by technology in that process is inescapable, and it's increasingly central, I think really at an almost dizzying pace. Central for those of us as consumers in our private lives, for businesses, the Internet of Things, ubiquitous sensors, smart grids, mobile devices that are reshaping commerce, reshaping how people connect, influencing how government services are delivered, generating new business models. All of that empowered by massive availability of data. And so big data is really becoming a touchstone for how we interact with technology, how companies interact with us, how governments interact with citizens. So if we go back to some of the beginning of the discussion this morning, that's one reason why the Bay Area, maybe the main reason why the Bay Area is doing as well as it is right now. We are at this epicenter of that process, shaping it and leading it, not alone by any means, but certainly leading it nationally and globally. And we have an extremely knowledgeable panel with us today to shed some light on this. We'll have perspectives from business, but also from government, and from the perspective of sustainability that I know we're all concerned with as well. So it's my pleasure now to introduce Stephen Teal. Stephen is a good friend of the Institute. He is the Director of Technology Vision, which also covers a lot of stuff at Accenture Labs. And Stephen is going to lead off the discussion and moderate and introduce our panel.
Thank you so much, Sean, and thank you all for having me here. I want to start by talking a little bit about what my team does to kind of give some context to this. So at Tech Labs in San Jose, we build Accenture's Technology Vision, which looks out about 3 to 5 years over what technologies will have the most impact over business and governments. And we really kind of limit our scope to the next 3 to 5 years and technologies that are investable today. And that strategy is much different when we're talking in the context of infrastructure for a region. You know, the next 3 to 5 years have already been decided last decade, and we really want to look out further. What can we do over the next decade to really influence technology decisions over the next 50 years? And those longer time horizons lead us to look at more of what are the drivers of change rather than what are the trends that we're looking at today. And so when we're looking at drivers of change, we're not just looking at technologies, we're also looking at those things that are the human components, right? Climate change, from ocean acidification to sea level rise and increased intensity of natural disasters and so forth. We're also looking at social and economic inclusion factors. The technology side of things is also very interesting, where we're looking at, at Accenture we like to say every business is a digital business. Whether it's the mom and pop bodega on the corner that's now using an iPad and tracking rich analytics on sales to understand what their stocking should be, to the mega industries of 100 years ago that are investing in technology and digital infrastructure and robotics in ways that we have never seen before, and they are literally disrupting their own markets and entering new ones. It's also about, as Sean said, the Internet of Things, where we're putting sensors on things that we want more information about to be able to give business managers that capacity to make informed decisions. And it's also the emergence of ecosystems in the technology world is profoundly important. All of you have seen this in the app stores, whether it's Apple Store or whether it's Google Play. That is just merely the first iteration. We're seeing this across businesses and industries as well. Excuse me. Across businesses and industries as well. And that is really making a cataclysmic change in the way that partnerships get created and businesses are able to leverage the technology and innovations of others in order to leapfrog their own industries. And finally, the component that kind of wraps this all together is data. And that's why I got so excited when Sean said, Stephen, will you come and talk to us about how data is influencing economic development in smart cities? The trifecta of things I just love to talk about. And so, the key that I like to say whenever I talk about public sector influence of technology is that we all have to remember that anthropologically speaking, technology is merely a tool. It's not there to advance the next widget or great gadget. It's really there to affect our human experience. And how do we leverage technology to affect that is really what we want to talk about as we talk about economic development and growth for the Bay Area. So in that stance, what we're looking at is in that greater driver of change, and how can we look at that movement toward a resilient region that's able to handle the impacts of not just technology, or incorporate the impacts of technology, but also handle those greater human impacts that I talked about earlier. And chief among those that's really driving the systemic change is what's happening with climate change. And that's why I'm going to call up our panel in just a moment. But the first panelist who I'm going to ask to speak is Ed Church, who's the executive director at the Institute for Environmental Entrepreneurship here in the Bay Area. And can really talk about the impacts that environmental stewardship is going to have over the next 50 to 100 years. And that's really going to be one of those macroeconomic factors that kind of shape the investments that we see businesses make. Next is Vijay Sameta, who's the Chief Information Officer for San Jose, who can really bring to bear the inclusion of these macroeconomic themes and how technology is being applied to the public sector. And then we have Laura Yoler, who's the Senior Vice President of Business Development at Qualcomm and President of Qualcomm Labs. If there's anything in cities that happens with residents, it's around mobile technologies today. There is no mobile technology or no mobile device that doesn't have some kind of Qualcomm technology embedded in it. Qualcomm is very much at the heart and center of our digital lives within the urban environment. And then finally is Bill Mitchell, who's a Senior Director of Worldwide Public Sector at Microsoft, and their City Next initiative, which is looking at cities globally and how can technology impact that growth that we're all trying to achieve. So with no further ado, I'll ask the panelists to come up.
We'll do a science eating next time.
And I was going to have the panelists do brief introductions, but in the interest of time, we're going to skip that part. Their bios are all in the pamphlets that you have. It is a really unbelievably great group, and I'm so happy they were able to join us today. As I mentioned before, Ed, if you could start out by talking about how climate science will really be a driver of data needs and regional action, that would be great.
Sure, thanks. I'm going to tell you some things you already know. I'm going to put them together in a different way than you probably put them together. So it's only been over the last 10 years really that the idea of climate change and what that means to us has really been impressed upon the public mind. Climate scientists have known these things for a long time, and the Intergovernmental Panel on Climate Change, for example, started writing about this 15 years ago, and there people have gone earlier than that. But it was really with The Inconvenient Truth in 2007 and with IPCC winning with Al Gore the Nobel Prize that people really became conscious of these ideas. And what I like to do is suggest to you that there are three drivers of change that will be realized in 50 years, but there will be transitions and changes that take us to those places before that. And technology will really, and data will really have a role to play in that. So 50 years from now, this is the territory of our children and grandchildren. So this is important to us. We will have adapted to climate change. We'll be here. We will have adapted to it. That means that if you can't grow food over here, you'll grow it over there. It means that if the airports have been submerged, we'll do something else, right? So we will have adapted to climate change. By the way, including the heat emergencies that are being proposed or projected by the city of San Francisco. I mean, heat emergencies, there will be increased heat emergencies over the next 20 years, 30 years. In the Midwest, for example, we won't be able to grow corn because we're going to be at 110, 120 degrees. We'll have to move a lot of what we do today to different places. Well, we will. We're going to adapt to that. The second thing that's going to happen is we are going to follow the first law of holes, which is when you're in one, stop digging. So we're going to dramatically reduce our fossil fuel use, 80, 90% less than it is today. Cars, no, gone. Some construction materials, sure, we'll be able to use those things, but mostly we will not be using fossil fuels, and this has real implications. And the third thing is we're going to start bumping up against real natural resource constraints. As the population of the world grows, as we begin to use things in different ways, we're going to start running out of stuff, including rare earths, to make all of our gadgets, the electronic gadgets that we use today. So those are three things that I think will be characterizing the world 50 years from now, and there will be stages in which we get to that, and that transition will be more or less painful. So I think what we're going to try to do is to make that as least painful as possible. So to us, what that means is that instead of technology sort of saying, well, what can we do? What is the Internet of Everything? And sort of pushing the latest idea, we're looking at what that society and economy needs 50 years from now, and they're going to pull stuff from us. They're going to say, we want you to be doing these things now, collecting this data, inventing these innovative technologies that will enable us to transition to that place as painlessly as possible. So what I wanted to do in that sort of short introduction was say, technology may not have any meaning. It's a bunch of whats, it's a bunch of hows. And I'm saying that there needs to be a meaning to it, and this is one of the meanings that we have for it, is what is going to be useful for us under those three new operating procedures.
Thank you, Ed. Vijay, in your experience, are cities incorporating that kind of thinking today into the technologies that they're delivering to residents?
Absolutely. I think we're at the early stages of it, certainly, but, kind of as my esteemed colleague mentioned here about change, change doesn't happen quickly in government. That's probably no shock. But I will tell you, something that you probably don't know, which is cities are cool. And I say that for a particular reason. They're transforming. They're becoming platforms. And not just for efficient government, but also to drive a strong economy, to drive better quality of life for residents. And I think we've all heard the Internet of Things bantered around that 70% of the world's population lives in cities. For San Jose, that really translates to a 40% growth by 2040. For a little bit of, and we're about a population of just over 1 million these days. So if you look at the makeup of San Jose, we're at the bottom of the valley, capital of Silicon Valley. And as we look at that type of change in our urban environment, it means driving design and urban design differently. So at San Jose, we've taken things like going to urban villages rather than the concept of having distinct locations in the city you go to for shopping and residential and industrial and businesses. We mix those things. So you live, work, and play in a small geography, which means fewer cars, fewer traveling, and really the streets are connecting these urban villages together. San Jose is 180 square miles. That's a lot to cover if you've got to go to a particular part of town from a congestion perspective. And to help manage that growth, it's about data, right? Typical government takes 20, 30 years to develop a plan. And as we look at sensor data and collecting that data, cities are transforming into platforms where we can see those micro changes that happen, the cause and effect in our ecosystem that we call a city, by understanding what happens when new businesses come in, new schools, new education, the impact of even the urban villages themselves. I use a very simple example with, my New Year's resolution to wear my Fitbit more often, right? It's those micro transactions in the macro that is going to shave off 20 pounds for me. But in cities, it is those micro transactions over time that help identify changing commute patterns. I think we can all remember a small city called Pleasanton where people used to go to buy inexpensive homes so that they didn't have to be in the Bay Area, quote unquote. Now, PeopleSoft and Oracle and a bunch of other companies have moved in there, and it's as expensive as some of the most expensive neighborhoods in San Jose. So what we see is, how can government react to that? Not necessarily proactively. We don't control mergers and acquisitions, not yet. But how can we react to that and shorten that time frame by seeing those canaries in the mine and the early warning signs of what's going on in our ecosystem and react in a shorter period of time. So I'll pause there and let everyone else jump in.
Sure, thanks. If there's any other comments, please feel free to chime in. I know, Bill, you
there was one other
sure, go ahead.
based on what Ed and DJ were saying. I think implicit, and I'm sobered by the notion that 50 years from now we'll be on the other side of climate change. Now, I might not be around, certainly my kids will be around. And implicit in that is an accelerated adoption of new technology. One of the many things I've learned while being at Microsoft for the last 10 years is that technology, we've done a lot of research on how quickly technology is actually adopted. If you look at some of the technologies that Apple made famous coming out of Xerox PARC, there's almost a 15 to 20 year cycle from when a new technology is invented to when it becomes widely adopted. So if you think about a 50-year cycle, there's only 2 or 3 of the current technology adoption cycles in there. So I think it's relevant to what we were saying about our local economic development and how technology it is a fundamental part of that. If you think of the acceleration that's required there, it kind of stuns me. I think it has implications for what we talked about this morning in terms of economic growth.
Are there any ripe opportunities locally here that you can recommend, Bill, that address that resource constraint issue?
Well, yes, so on the flip side of that, I think if we look at how technology might be applied to how we manage resources, one of the things that I've been really interested in over this last year of work that we've been doing with the University of California Davis is how do you manage water and energy together more efficiently? What's the nexus of energy and water? What does that mean to us? And when we talked about infrastructure this morning, a comment was made about the utilities in general, but I think there's significant impact, potential impact right now based on the shortage of water we have in California at the moment. Seeing as we're in a drought, it's difficult to forecast when that ends, and I think the opportunity to take action on how we manage energy and water together is something that we can work on right now, and the technology is there to do that. The data analytics are there to provide in-depth analysis of water rate structures. These are the big data problems that you mentioned when you kicked off the panel. There's ripe opportunity there. And once you dig into that and add sensors into these, let's just take water as an example. It's very easy to determine where you're expending the most energy, within that system, where the system is leaking, where you're likely to have a pipe burst. All of that's there in the data right now, so it's a big opportunity.
And do you or the other panelists have a comment on the use of water in urban environments versus agricultural use, where maybe one is monitored more than the other and measured?
Yeah, I do. I mean, water is energy. The natural resources defense
Especially
council,
in California.
Yeah, they pointed out that 19% of the energy used in California is used to move water. Now, some of that is used to move it over to Hatchepies, but some of it is moved within various areas here. And when we think of reducing fossil fuel use and therefore developing alternative energy, and how we use our energy, we have to think about how we use our water. So next time we have a rainstorm, it should only happen sooner rather than later, but the next time we have and you're walking along the street, look at all the water being flushed away. It's just, I just want to capture it and say, wait a minute, come back. We need this water. Why are you going away? We spend then energy to treat the water that we are trying to flush away from it. So we're just letting it go. That will change.
And giving a higher level stat, the World Bank did a study of water broadly, globally, and in developed countries, over 50% of water is lost through both leakage and pipe bursts, and they estimated $14 billion a year is lost in lost revenues due to those water leakages. So water is a great place where you can put some very inexpensive sensors and stop that loss. So 50% of water being lost of the stuff we are trying to transport in developed countries is an astounding statistic to me.
Thanks. And while we're on the point of water loss, particularly in transmission, how do we, what other technologies can be brought to bear either on that or other technologies within cities to have game-changing results? Lori?
For me, it's interesting. I've been attending a lot of Internet of Things discussions recently, and although I'm excited about all the innovation, and if you look at Internet of Things, they're predicting that somewhere between 25 and 50 billion new devices are going to get connected. And the reason I'm here and the reason I'm excited about working with cities and why Qualcomm's excited about working with cities, I think the folks in the cities have the absolute toughest job. Because if you're a telecommunications company or a company, yes, you have to manage your employees who bring their device to work and they want different devices of different flavors. But in a city, every one of your citizens has some device, and you're seeing more and more devices that are coming online in a completely unmanaged fashion, and yet these are citizens that expect privacy, expect equity, expect security, expect all those great services to be delivered now on their mobile device, whatever it is. So I see cities having the biggest challenge, and in particular the Bay Area, because of course we expect every device to work because we have all that venture capital flooding into the area, supporting all these new entrepreneurs. So as I look at all these new technologies, the common thread that we're looking at is we're kind of looking at the development of the smartphone. If you remember, 10 years ago, your phone did one thing, it made a phone call. And now we've seen the evolution of adding better and better cameras to be able to take pictures, adding different sensors so it knows your location, adding, allowing it to be a musical instrument, allowing it to be a navigator when you're driving, allow it to do all these other things. And we're seeing sensors in the cities, and in particular infrastructure in the cities, taking the same kind of path. For example, I was with the CTO of LA last night, and he was telling me that they now have 4,500 infrastructures in LA now instrumented with sensors to be able to monitor traffic patterns, how many cars are on the road at any point in time, how fast are they going. But those same traffic signals or light posts in those intersections could also be used as Wi-Fi hotspots. They could be used with security cameras. They could do gunshot detection. They could provide environmental sensing to see what the pollution is. So why reinvent the wheel? And I'm all for the innovation of all these small companies with ideas, but in a city you have existing infrastructure that's been funded, and instead of ripping and replacing, what we're saying is let's look at multi-use. What can we do with the existing infrastructure to update it and to bring in the innovation of all the entrepreneurs around who maybe can build an app for you for free, and you can bring them in as entrepreneurs in residence, or do hackathons that we're seeing in some cities to say, what can I do with this existing infrastructure to provide equity, to make everyone more secure, and to provide that privacy, but not having to rip and replace given that budgets are cut.
Great. VJ, it looked like you might have some thoughts there.
Absolutely, no, I think that's a great comment, and is very much what I mean by cities becoming platforms. The smart pole of the future that supports these multi-use type innovations that have both shared risk, shared investment, but also shared reward between public and private sectors. We've got the site acquisition, they've got the technology, it sounds like a perfect marriage, and it drives value to citizens. And perhaps one of the coolest things that we've done in San Jose is we took our intelligent traffic system, where we know, obviously, when the lights are going to turn green, yellow, and red, and provided that real time to a German auto manufacturer who shall remain nameless. And what we figured out was, in a proof of concept with them, is how in an urban environment, kind of until everybody buys electric vehicles and they're all charged by solar panels and have battery storage on-prem, disaggregate the grid, how can we get even more performance in an urban environment? And one of the things we found that was super interesting was we could actually slow down driving and start to predict when you could hit all the green lights, which sounds very counterintuitive. We didn't let the company know when they were about to turn red so that they could punch it to the stoplights, but it was an interesting concept in providing that data that cities already have. They're typically locked away, and open it up in an open data type fashion and serve it up in real time that lets you as the driver make decisions about your experience that have you slowing down to getting to work faster. And so it's that type of power within city data sets that can drive an entirely new economy. And now, wouldn't it be great if all cities were standardized on the same, exact technology? But I think that's part of the premise around cities becoming platforms, is that this type of data becomes ubiquitous and it's open and it allows for opportunities of an emerging economy. And the investment in the hardware and the site locations just happen as a natural course of trying to solve really big problems like climate change and how we deal with that.
As the city becomes the platform, it sounds like you're becoming service provider as well. Are you displacing others, or are you creating new markets?
I'll say yes. In probably I'm not sure that the views of my views represent those of the city of San Jose. And we'll see if I remain this guy. But realistically, I think there's been a tremendous opportunity that we've seen. I mean, there's been, and just kind of a really simple example. We took excess bandwidth that the city had in our downtown core, where there's old infrastructure in the middle of, a recession, and we started lighting up vacant buildings with high-speed internet access. We're not trying to compete with Google. We're going to beat them. Nobody's going to beat them. Oh, sorry. But the opportunity around providing high-speed access has, before we even announced the first building, there are already tenants moving in. And part of our giving away the internet bandwidth had the building owners, as they started to fill the building, start doing street improvements, right? So this is back to my core premise that we drive a strong economy, we start enhancing the quality of life of residents in downtown and your downtown experience. And that's all done through simple investments. Yes, we're competing with the incumbent, cable and telephone operator, but one of the things, and we don't plan to be in the ISP business forever, but one of the things that was incredible about that, the very next meeting at our downtown association, it changed the conversation about what it takes for those companies to invest in San Jose. So a little competition goes a long way. Chattanooga's been incredible for doing that. Residents and businesses have access to high-speed internet. And it sounds weird that in the middle of Silicon Valley, that's still an issue, but it is. And so that's a great opportunity.
One more example, you're talking about it, the previous discussion talked about the importance of education in being a great equalizer and promoting job growth and equality. And I spent a lot of time looking at the education sector at Qualcomm, and we certainly believe in it. And what became very clear from all of our research is, as we're adding more and more of these wonderful online resources, and here we have the Khan Academy that's adding terrific opportunities for students to continue their education at home and not just in the classroom, it became very, very clear that connectivity was going to be absolutely important for that. So I think as you look at the city with education as well, connectivity is important. We just were awarded with a team. We created a joint venture with a number of partners in New York. And as we're talking about how you pay for things, New York has a vision to provide high-speed internet to every one of its citizens for free in all of the boroughs. And so what they did, back to the infrastructure, they realized they had payphones on every corner. They have 10,000 payphones that were just sitting there pretty much unused and having graffiti on them. So they put out a tender saying, why don't we use these, turn them into interactive kiosks that are Wi-Fi hotspots and allow anyone to come in and make a call for free. And it is 100% paid for with interactive advertising and sponsorship. So a lot of the banks are already coming forward saying, I want to be a sponsor for this borough, and they think it's wonderful to allow all citizens to have access to internet, so they'll provide both city services in these locations, information, 311, 911 kinds of services, phone calls, wireless charging, all kinds of things at these old payphones that are now being put in place as kiosks where they already had to draw fiber before to put in the payphones, so existing infrastructure, but doesn't cost the taxpayers and citizens anything, 100% paid for by advertising, and the expectation is the city will actually make hopefully at least $500 million over the next 12 years in revenues, because we structured it as a revenue share. So there's a great opportunity to provide that connectivity and access for all the citizens. And they were very clear they wanted all the boroughs to have that high-speed internet.
Ed, did you have something to add there?
Yeah, I just wanted to intersect, you mentioned the infrastructure and crumbling infrastructure and how it can be rebuilt. I want to intersect that with data. And we're helping the Chancellor of UC Berkeley to plan the new Berkeley Global Campus at Richmond Bay. And one of the things that we're looking at is exactly that intersection of new infrastructure possibilities and data. And I just wanted to give everybody a great example of one of the things we're looking at, which is the Bullitt Center. It's B-U-L-L-I-T-T, Bullitt Center in Seattle. And basically, it's designed to be a living building. So and it's designed to last 250 years. So they collect their own rainwater, they generate their own electricity, they compost their own sewage. There's no stormwater rain runoff from the place because they have bioswales and permeable surfaces and so on. Okay, so what's the infrastructure? What are the pipes and the wires and the roads and so on that are now connected with that? If you can imagine that kind of a building as opposed to a conventional building and all the infrastructure that needs to serve that, what would it mean to proliferate that kind of living building that in many respects carries its own infrastructure with it?
I love the Bullock Center. And just as a side note, Dennis Hayes is the guy driving that, and he happens to be the founder of Earth Day. And I think that's a quintessential landmark in Seattle right now. And I think the interim step there is what we can do with the existing infrastructure, the existing built infrastructure we have, and how we make that as efficient as possible. And I think the audience here is probably, everyone's familiar with, oh yeah, smart buildings are happening out there. It's not a technology issue. We know how to dramatically reduce the carbon footprint based on the energy of any building's consuming. We do that on the Microsoft campus. We run a carbon neutral campus using IT infrastructure to manage our consumption. Same is true in the city of Seattle. There's projects there. There's projects all over the Bay Area. I think the challenge that government has is how do you enable this type of technology to really proliferate? There's a lot of barriers in how government's structured now and working across public and private partnerships. So I think there's a real business process that needs to be tackled to enable these new scenarios to really scale up on a large scale, where it can make the kind of impact that we need to make to address climate change. And the other thing that occurred to me, we were talking about infrastructure. I think it's really important to think of data is your infrastructure too. Usually, it's very common for us to think, okay, the infrastructure is this physical thing, and data is this IT thing. Data really is part of the infrastructure. You can think of it, if you think of a brand new building, any sizable commercial building today, when you take delivery of that building, you also take delivery of the data for that building. All the design, as-built drawings, and how that building operates. So the technology infrastructure and data really are part of our overall infrastructure.
That's a great point, Bill. Last week I was at International Federation of the Red Cross and Red Crescent Societies looking at how to build more resilient cities. They had a workshop in the Netherlands on that with people from all over the world. And one of the top 4 projects that came out of that they're going to be investigating further is looking at unmanned aerial vehicles and drones of how do we get communications infrastructure back up as fast as possible after natural disasters, because more and more our resilience story is about data and how do we get communities to communicate together. And the last question I have to the panel is examples of that. How can we use technology to build more resilient cities and more resilient regions?
It's simple. I was at a meeting in Chicago last week and talked to the director of emergency preparedness for the city. And it was so interesting to me that the way Chicago is using the data they already had. And I'm sure cities are doing this everywhere. VJ has a number of projects like this, but I love the way the city was taking their 311 data and 911 data from the severe rainstorms that are happening now because of climate change in Chicago, the wastewater runoff problems they're having. But they're using that data to drive very accurate flood predictions. It's another example is data as the infrastructure, but also using that to create a resilient model to handle that emergency scenario. And one other, I think another interesting technology development that's happening now is the emergence of microgrids delivering electricity to critical facilities. I think that's another area where the marriage of IT and the physical grid are going to make a big difference in terms of how energy is managed in a crisis or in a scenario where
I knew San Francisco has a project to do this for earthquake preparedness. But for me, it starts with the availability of the data, first of all, and the opportunity to bring it in from all the citizens. So I think for emergency preparedness, allowing citizens to be able to report where there's food, where there's shelter, and use whatever communication device they already have to be able to contribute, much like what Waze has done for real-time navigation and reporting of traffic incidents. We work with a company called Public Stuff that allows non-emergency data to be reported by citizens. And so I think looking at those systems that allow you to harness the power and the intelligence and the data from all of your citizens and bring it all in together to be able to react to it. And I think one of the other things to keep in mind is in data architecture, what is the data that you need in real time, where you want to incorporate sensors and citizens, and it's really important that you have access to real-time data, versus what is the data that you can be looking at historically, that you can be processing somewhere else, and looking at trends. And I think so as you're looking at the data architecture, I think that's really important for the difference between emergency response and the difference on interesting data that you want to make policy decisions or recommendations based on.
Yeah, I think we're seeing a lot of interesting trends kind of come together. I mean, things like social networking being used for, community services, whether it's next door, neighbor goods, that type of stuff. Also other major trends like, juice box energy, the disaggregation of the energy grid, solar panels, and that type. So inherently, over time, our communities are becoming more and more resilient, right? And quite frankly, they don't have to rely on government to do that. They're able to do that in this kind of mesh peer-to-peer fashion that allows you to understand if my house fell down, well, I've established these social networks with my neighbors around me, and we all take care of the common good. And quite frankly, government doesn't have to be in the middle of that. And I think that's extremely powerful for that concept. Because otherwise, it's just one more thing for government to do. And if it's not a crisis, it's probably not at the top of the list until it's a crisis. So I think the opportunity is these trends really just starting to shape themselves in a manner where it isn't a single entity, which is sometimes scary when you think of, hey, I used to go to the big energy company or the big oil company to get something. And now that's, the sun, my rooftop, and a storage platform. And that's an incredibly powerful concept. And I think that will inherently, over time, make cities more resilient. In fact, if you look at a lot of emerging countries and emerging areas of the world, they don't do things the same. Nobody digs up the street to put copper in it anymore, right? They just throw up wireless networks because they're able to leapfrog and take advantage of that investments and knowledge that we've all done over time. So when I think of the cities of the future that are, and trust me, there's like 12 of them being built all around the world, the cities of the future, as we look at those, what's really interesting is what's going to happen just kind of organically in the existing urban footprint that exists. I'm always fascinated by Detroit for this very reason. How do you reboot that urban environment? And I don't think it's any one entity that does it. I think it's a network of market trends and just kind of the evolution of society.
So I want to key on a couple of things. You mentioned that the abilities of cities to adapt to some of these new technologies and so on. One of the things that Dennis Hayes found when he was doing the Bullet Center was that he had to meet with the city planning agencies and so on because they were building a living building and none of the codes corresponded to it. So fortunately, the staff in the city of Seattle would say, bring it on, let's figure this stuff out. And the other thing that was key to the Bullet Center is the measurement of their electricity so that they could monetize the difference between what tenants are conventionally paying and what they might be paying now, and that gap is what pays for the energy efficiency and energy generation. But I also wanted to key on, Vijay, your idea of the more compact urban area that is much more self-sufficient. Now, self-sufficiency can also address the resilience questions. And so it occurs to me that if, according to what we project, and probably everybody would agree, we're going to be reducing our fossil fuel use. AB 32 is more and more reducing the amount of carbon that's going to be permissible, and that's going to continue as we discover more and more about global warming. It's going to become more and more stringent. Okay, so when we think about that, we might think of ourselves not just as the producers of carbon, but as the consumers of carbon. So we are consuming carbon produced in China right now. Our pants, okay? Our pants are generating carbon from coal-fired plants that are transferred over here on diesel-powered ships, okay? As we move along with the real understanding of what global warming means, we're going to stop doing that. That means that we're going to bring home our pants. We're going to start manufacturing stuff here, right?
Tweet that.
And in these compact places, all right? We used to make stuff in this country, right? We're going to make it again because we can't afford the carbon footprint that we're now offshoring to China. And by the way, we're also breathing in their pollution at this moment. It's actually our pollution that we're causing them to do over there. But I keyed on your remarks about the information society, how we're transforming from being an industrial to an information society. I see the transformation back in the other direction, towards more of an industrial society, so we meet more of our needs locally, so we become more resilient to climate change. And I think I'd actually like to hear some comments about that potential change back to what we used to do as a country and as a Bay Area.
Thank you. With 10 minutes left, we'd like to open the floor to questions.
Yeah, so I have a question, but let me respond to that. Manufacturing, much of manufacturing is never left. And a lot of manufacturing is coming back, but not in the way that people think. And what I mean by the information society is those pants are going to be manufactured here, but not by people. And that's the difference. So why are they going to be manufactured here? I think not so much because of the carbon issue, but when labor becomes a much smaller part of the cost equation, country risk, transportation costs, attenuated supply lines become much more important. And so I think you're exactly right that we're going to produce things closer to home. But when people say, let's bring manufacturing back, they're thinking of the big Ford assembly line. That's not happening. In fact, we're producing today, manufacturing today, in California, 140% of what we did in 1990, with a third less people. So that's what I mean by the information society. It's information that's going to drive those factors. But now my question, and I'm going to do this with an example of things that you alluded to. I think the single largest use of energy in California is getting water over the mountains to the San Fernando Valley. San Fernando Valley is also the headwaters of the Los Angeles River. In an average rainstorm, Los Angeles River outflow into the Pacific Ocean is second only to one river in the U.S., the Mississippi, as it flows into the Gulf, past New Orleans. So huge water flows. But if you're going to sort of address those issues, which you all have brought up, you have a number of governmental agencies, a number of utilities, and they all have to kind of get together and say, we've got to have this common goal. And how do we solve it in that way? Well, they may not have a common goal. So what strategies either exist or ought to exist in order to bring together these disparate interests to solve this problem? Or do we need a crisis for it to happen?
We got a crisis.
Or do we need a recognizable crisis?
I mean, it's just drawn out. It's a drawn out crisis. You know, some of this is also a crisis of leadership. I mean, we just need the leadership to pull these things together. The Southern California Association of Governments, for example, would be a terrific organization to take on exactly the challenge that that you mentioned. I mean, we are moving gradually into a society in which we will not waste energy, we will not waste water or resources, and we won't waste people. I mean, we're wasting, look at the charts up here about, you know, the disparities and lack of wages and unemployment and so on. We're not going to be able to do that. This is an all hands on deck kind of transition that we're making. And I think realizing that as a whole is somewhat tough, but that it is a whole, and it requires a shift in the mindset of the whole that we have now toward a different whole. The planet is moving us that way, and we just have to get on board. I mean, our work is not to tell people ethically what to do. We're playing, you know, catch up with the way the planet is moving here and what that means. And I think once we realize that, we realize more about what we've got to do together. But it's really going to take leadership.
As we get to other questions, I'll rephrase that challenge into something that, you know, a consultant can understand. What can we put a sensor on to measure that? And so, are there other questions that we can take from the audience? Sean?
Look,
5 minutes. Sure.
How can we?
We can hear you.
How can we expand the conversation that we're having to include health and wellness? Okay, and what factor might play into it in terms of, like, we're familiar with the LEED certification, and now there's a new phenomena coming out of Douglas living in New York City regarding wellness. Trying to take all the dimensions that you're talking about, and bringing it down to people, and whether it's a healthy building, a healthy community, a healthy city. So this whole concept of health and wellness, tying it to more closer to people.
So for those who may not have heard the question is, how can we tie this back to health and wellness and people? After BJ lets me borrow his band that's going to help me drop 20 pounds.
So I think this is the exact concept that I was referring to about cities becoming platforms. I think in a lot of respect, a lot of the privacy regulations and things like that prohibit a lot of this from happening. But if you're already doing air quality sensing within your city and you can start identifying cause and effect, and, you know, gee, are more people having respiratory problems in this part of town versus this part of town, you can really start mining that data and getting down to what the cause and effect is. I think it's challenging because other government agencies, not cities, have, you know, very strict regulations around things. I mean, I was surprised as we were looking at some initiatives in the city that the power usage for my house, and I'm a homeowner in San Jose, is the city receives it, but it's considered confidential. So that's very odd to me, because in order to tackle those big things, we need to get that, you know, leadership across many different areas, whether it's the utilities, government, residents, businesses, and get them to move in a common fashion. And I think some of the regulation challenges that a little bit, but I think the value in what you're saying about kind of having the, you know, LEED Platinum for, you know, healthcare requires that type of change. And cities are able to use smart poles to collect that type of data. We really just need to analyze disparate data sets and start drawing those cause and effect conclusions to have a more educated conversation about healthcare. and my Fitbit isn't going to do it all by itself. It's like 3 years old, I just put it on.
I was going to say, in London, they had a big open data initiative in the UK a few years ago, and I participated as a judge in the hackathon, and a lot of the applications were around at least finding the closest emergency room and being able to make appointments more easily with different physicians. And I've seen a lot of stuff at the mobile app level in terms of reducing waiting time, but I think here the regulatory framework is such that a lot of the data isn't open and we have a lot of regulation around it.
I love that, the Fitbit. I love that because it ain't gonna make you slimmer, okay? It's gonna record your movement that makes you slimmer. And that kind of mystery about what data does versus what data records, I think is important. The U.S. Green Building Council in Northern California is in the process of doing a Build Health initiative. I did a panel there last month or something, and I'm gonna ask you the same question that I'd love to ask urban planners. Give me an example of alternative transportation. Walking, bicycling. No, it's cars. Okay, the primary transportation for human beings is walking. If you're lucky, you get a couple of wheels. If you're really lucky, you get some kind of mobile thing that's with a lot of other people in it, called a bus or a BART or whatever it is. Way down the line in human history is this thing called automobiles. That's alternative transportation. If you put that right side up in your planning, in your thinking, you get slimmer, you get less pollution, you get all kinds of goodies, but we have it upside down right now. So that's a lot of these transformations take place between our ears.
That's a terrific point. It reminds me of the CEO of Fitbit said, you know, with our troves of data, millions of users, and a lot of money spent on analytics, what he can tell you without a doubt is that diet and exercise helps people lose weight. So last question in the middle there.
I really like the idea of sort of IoT being making cities into platforms. I'm going to steal that. So over to Bill. So what do we in the software world have to do to take advantage of this?
You know, you could probably get a bunch of different answers for that. I think one of the shift that's happened in the world of software right now is what cloud technology is doing to enable all these solutions. You can't have a smart city. You can't aggregate all this data from all these devices without having this ubiquitous cloud infrastructure. That's, I think, the fundamental change. I think now that you have a place where you can, let's say, call it technology that allows you to realize these benefits, you have to take a look. I think from the perspective of this meeting, this council, looking at government, it's about making data available that's going to enable the scenarios that we're talking about. There's still a lot of work to make that data available. And we also use we also talk about data like, okay, it's just a thing, take the data and go do something useful with it. Most of the data that's out there needs a tremendous amount of effort just to make it useful. So one of the things, the water scenario I talked about, when you look at aggregating data across the hundreds of water districts, everybody keeps their data in a different format. It's under somebody's desk, it's down the hall, and so when you go to, and that's not, that's how it works. And so having the tools that can accelerate these processes, I think, that's one of the fundamental issues that needs to be addressed. How do we make this data really useful, make it happen, more easily for government, and where you don't need to be a data scientist that can program an R to drive these analytics. Those tools are getting there, but I think that's one of the fundamental changes.
I'll add as well, look at platforms and ecosystems. How can you contribute to something larger than that, or larger than yourselves? And a lot of times there's public sector stakeholders that are part of those ecosystems, and you can get your tools kind of incorporated into something with a much grander audience. And the last comment that I want to make is that please be on the lookout February 3rd, this shameless self-plug, Accenture.com/technology vision, that will publish the 2015 technology vision, where we'll talk about these and other great topics. Thank you.
Thanks very much, Stephen, and thanks to our excellent panel. I think you'll agree that there's a tremendous amount of insight with our panelists. We could have gone on and on, but we want to be respectful of your time today. As we wind up this year's forecast, I want to add a personal note. Many of us know each other, so this will be my last year as president of the Institute for the forecast. In a couple weeks, I'll be stepping aside as president. I'm not going away. I'm going to be part of the Institute, senior director, going to be focusing more on policy, more on external-facing things, more on research, and we'll be turning over the president's job to Michael Weinberg. Dr. Michael Weinberg has been a fellow at the Institute for 4 years, has led our healthcare activity, has a terrific background before that in economic development policy. I think you'll enjoy working with him, so you might just wave your hand, Micah, stand up. I encourage you to walk up and say hi to Micah, introduce yourselves. If not, he'll find you sooner or later. And with that, I want to thank John Williams and the Federal Reserve Bank of San Francisco again for hosting us. John's a member of our board of the Institute. We're very appreciative of that. I want to thank Accenture again for being our partner and our sponsor for this event. I want to thank Jerry Nickelsberg for coming up from Southern California and bringing that perspective, and the Anderson School for being our partner now for many years in this activity. I want to thank Tracey, Stephen for leading an outstanding panel, and thank you all for coming, and see you next year.